let me try to be clear, because my message is a bit confused. In the very short term, I think gold is vulnerable to Powell, to strong rhetoric from Powell, because the market is not expecting that. Exceptionally bullish. Because what makes gold bullish is not if interest rates are going up, not if inflation is high. That's not what makes gold go up. But if the market believes, if interest rates are going up, but the market believes that the Fed will not continue to raise rates until inflation's under control. Yeah, I think gold will exceed this all-time high. So yes, I think you need much more than 5 to 10% in gold assets. The economy is so far defying expectations of a recession, is holding up a little better than a lot of people, including me, have expected. But I wouldn't sort of put too much on it, frankly. I mean, if you look at that GDP number, as you say, it was way down from the previous quarter. A lot of the increase was government spending and trade being a result of a falling dollar, which still contributes to GDP, but we have to look at what was the reason. And I think that the critical thing, Michelle, is what Powell himself, Jerome Powell, the Fed chairman himself, commented in his last press conference, quoting Milton Friedman from 40 years ago. The monetary policy works with long and variable lags. So some things like autos, housing, which are very interest rate sensitive, you know, they respond to increases or decreases, for that matter, in interest rates very quickly. But other things, those lags can be as long as a year or 18 months. People forget that. So when people like me say we are heading for a recession, I don't think there is any way the U.S. will avoid a recession. It would be unbelievable if the Fed came out and said, well, we're not going to raise rates this quarter. So any surprise is going to be on the higher rate, not on the lower rate. But I'm expecting 25 basis points. But the real key is what Powell says in the press conference afterwards. That's the real key. I don't think Powell's going to say we're not going to hike again for a while, but I think the tone is what's important with Powell. Is he going to, because he's not going to give a prediction on what they're going to do, but the tone is important. Well, I've been saying for 10 days now that I think gold is vulnerable to a pullback because the market is so convinced is 25 basis points and a pause in March. If Powell comes out, Powell doesn't like the fact that the stock market is continuing to go up, right, which means the stock market is not taking him seriously. And so his incentive, I think, his incentive is to come out and say something strong. That we're going to keep on with this job until inflation's defeated, blah, 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 blah. Powell and the Fed, this Fed in particular, under Powell, is very data dependent. They look at the data very closely. And so the GDP number will say to them, maybe we can keep hiking a little bit longer. The gold market is already priced in 25 basis points, and very few people have any question about that. And it's already priced in a pause in March, I think. Okay. So it's vulnerable on the downside. We saw the bottom in October, September, October. We've already seen the bottom up. We could easily get back to 1870. It wouldn't bother me. Okay. 1870, 1880, if Powell comes out swinging. Because the gold market is already priced in a pause. And again, employment is another thing that tends to have a lag. When you think about it, you know, especially in this sort of employment situation that we have, everyone's been talking about how employment is so tight and how it's so difficult to hire new people. Well, in that environment, you tend to hang on to people a lot longer than perhaps you might otherwise have done. And of course, for small businesses where you know your employees, you tend to be very reluctant to lay off people who worked for you and worked well for 5 years, 10 years. You know, you don't really want to lay them off. So you hang on to people longer than perhaps you should on a purely economic matter. If you look at Hong Kong, Europe, Britain, they've all had their own particular things. Hong Kong, of course, with the China reopening, they were locked down for so long. Valuations in Hong Kong just got stupidly cheap. When you look at the S&P, we didn't have those sort of circumstances. We hadn't just come out of a lockdown. Stocks were not ridiculously cheap to begin with. I think I think the S&P is heading for a fall. When you look at the S&P right now, it's trading at 18.5 times earnings. Bear markets do not end at 18.5 times earnings. If this bear market is over, it will be one for the record book. If you look at the S&P last year, it did 226.5 or something dollars per share in earnings. Consensus analyst expectations for the coming 12 months are 226.1. Consensus estimates are that the S&P earnings are going to decline by less than 1%, considerably less than 1%, right? Considerably less than 1%, basically flat. You know, how can that be true when you look at the earnings we've already seen from Apple and from Microsoft, when people are laying off people across the board, when the economy's slowing, when retail, when the consumer credit debt, you know, is at record levels? How can it be true that we're not going to see a decline in earnings this year? 2% to me is not killing inflation. 2% is perverse, to me is perverse for a central bank to say we want 2% inflation. They should be targeting 0% inflation. He has been saying for a while we're going to get inflation down to 2%, we're going to continue till the job is done. At the last press conference, he was asked a question, you know, what circumstances would you cut rates? He made a very interesting comment. It's the first time he's talked about when they will start cutting again. He did talk about some kind of systemic risk would cause them to cut rates. That was interesting to me. He didn't have to say it. It was superfluous. But he also, you know, when your message is we're going to keep on till the job is done, why do you talk about, well, of course, if there's a systemic risk, we'll cut rates again. But he also said, we won't cut rates until we are confident that inflation is on the path down to 2%. On the path down. That's totally different from saying until it's at 2%. So I think the Fed pretty soon the Fed can legitimately in their own eyes claim victory. Let me try to be clear because my message is a bit confused. In the very short term, I think gold is vulnerable to strong rhetoric from Powell because the market is not expecting that. If Powell is convincing, gold is vulnerable. But if we look out a month or 2 months or 6 months, I think we're getting very, very close to the point where the Fed will pause. I hate the word pivot. Will pause, and that will be, and they will pause before inflation is at 2%, or if it gets to 2%, it will bounce off 2%. You know, it'll bounce off 2%, because remember, we've got this base effect now coming in. The base effect now is working the opposite it was last year. We've had high inflation numbers June, July, August last year, so obviously you would expect with the base effect, the inflation numbers to be lower this year. The S&P is simply not pricing in a slowdown, not even a recession. They're not pricing in a slowdown. I think a 10% decline in earnings is an exceptionally cautious forecast. Exceptionally cautious. If earnings come down 10% and the price earnings multiple contracts by 10%, that's essentially a 20% decline in price. That would be my bottom line decline. I think it could easily be more than that. Exceptionally bullish. Because what makes gold bullish is not if interest rates are going up, not if inflation is high. That's not what makes gold go up. But if the market believes, if interest rates are going up, but the market believes that the Fed will not continue to raise rates until inflation's under control. We saw that very clearly in the 1970s. People forget, everybody talks about how weak Arthur Burns was, you know, but Arthur Burns was raising rates consistently, quarter after quarter after quarter. Rates were going, interest rates were going up, but he was always lagging inflation, and the market did not believe that he had the conviction to continue until the job was done, and the market was correct. When Volcker came up, he put rates above the rate of inflation, and the market believed he would do the job. and gold collapsed. Yeah, I think gold will exceed its all-time high this year. 5 to 10% to me is for physical insurance, right? It's for physical insurance. We're not talking about buying Moose Pasture Inc. That's not part of your 5%. So yes, I think you need much more than 5 to 10% in gold assets. Now, I think 5 to 10% in physical as an insurance in your own grubby hands is the safest, is the base. Right now, my focus continues to be on the senior stocks, both the miners and the royalty companies, because those are the surest, those are the first to move and the surest to move. Already the XAU's up, over 35%, 36, 37% since the lows in October. But those stocks still have much more room to move in the near term, I think. So my focus continues to be on the seniors. Now is really the time to also start adding the juniors and the exploration companies. The exploration companies are stupidly cheap right now as a group. The problem, of course, is that you have to be much more discerning about what you buy. And the volatility not only is the volatility higher, but the risk of certain companies just not performing is much higher.